Assalamu alaikum viewers. My name is Sakif Wala, and as a part of Rehan AI teacher training course, I'm back with another discussion session. The topic of today's discussion is the understanding of basics of the financial independence. And today our guest will again be ChatGPT. So let's dive.
Got it.
Hello ChatGPT.
Hello. Great to be here. Let's dive in. So,
So
financial independence is
what does financial
usually,
independence actually mean for an ordinary person, and does it necessarily mean becoming rich?
for an ordinary person, financial independence doesn't usually mean being super rich. It means having enough stable income, savings, or investments so that essential expenses are covered without constant money stress. You don't need millions. You need enough for your needs and a cushion for surprises. It's about freedom and security, not luxury.
Great. So, where can one start from on the journey of financial independence?
A great starting point is tracking your income and expenses. Know where your money goes. Then build a tiny emergency fund. Even a few $100s helps avoid debt when surprises pop up. After that, focus on high interest debt first, while gradually beginning consistent small savings. And don't underestimate learning. Basic concepts like interest, inflation, and risk really pay off over time.
You mentioned to know your expenses. So, why is it so much important to know where your money goes than the money you earn?
Because clarity creates control. When you can see exactly where your money goes, you spot leaks, cut stuff that doesn't actually matter, and redirect it toward what does, like debt repayment or savings. Without that visibility, you're just guessing. And small, untracked habits can quietly swallow a big chunk of your income.
Okay, but in one's spending, there are different levels of priority. Person has necessities, he has needs, he has some wants. So, how can someone say which expense is he is losing out and which expense is justified?
A simple way is to sort expenses into three buckets: needs, like housing, food, transport to work, then wants, like streaming subscriptions or eating out often, and savings or debt payments. First, protect the needs, then make steady progress on savings or debt, then allocate what's left to wants. If money's tight, trim the wants first, negotiate bills if possible, and avoid cutting things that keep you healthy or employed. It's about balance, not perfection.
Sure. You mentioned about some of financial concepts that a person needs to understand. One concept that particularly interests me is inflation. Can you explain inflation for a layman person?
Sure, inflation is when prices of goods and services rise over time. So the same amount of money buys less stuff than before. For example, if milk or bus fares cost more this year, that's inflation, which is why saving without growing those savings can actually lose value over time. People deal with it by seeking investments that at least keep pace, or by increasing income through skills or side work, because cash alone tends to slowly lose purchasing power.
Now, there are two questions on this concept. You mentioned about keeping an emergency fund to prepare for worse times. So, what is the rule of thumb in creating this emergency fund, and will it not be affected by inflation as well?
Checking. Great question. Rule of thumb is 3 to 6 months of essential expenses, a bit more if income is unstable. Yes, inflation can erode its value a bit, but the fund's main job is liquidity and safety, not growth. So keep it in a place that's easy to access, and invest longer term money separately to potentially outpace inflation. Think of the emergency fund as a seatbelt. It's to keep you safe, not make you rich. For battling inflation, investments suited to your goals and risk tolerance are the usual tool.
Now, please elaborate on the concept of debt. Can there be some debt that is good for us, and why debt sometimes slow down our journey towards financial independence?
Looking it up, that's an important one. Broadly, there's good debt and bad debt. Good debt can be a student loan for useful education, a reasonable home loan within your budget, or capital for a business that can earn. Bad debt is high interest credit card balances or borrowing for things that lose value fast. Debt slows financial independence when interest eats into your ability to save. The trick is borrowing only when there's a clear long term benefit, keeping repayments manageable, and paying off high interest debt as early as possible. Think good debt builds opportunities, bad debt finances today's lifestyle at the cost of tomorrow's freedom.
What, in your perspective, you mentioned about house debt? Currently, there is a scheme going on in Pakistan where government is offering a house loan for an amount of at most 1 crore. For first 10 years, the interest is 5%, and for next 10 years, it is Kyber plus interest rate, which at the current rate is about 14.5%. What is your perspective about such a debt for a person that has a pay of say 80,000 rupees or 100,000 rupees per month?
Checking. That's a very grounded question. My take, focus less on the initial 5% and more on whether you can comfortably handle the payment if rates rise after 10 years. If the future installment would strain your budget or stop you from saving, that's risky. A house should support your life, not trap it. Make the decision based on long term affordability, not just today's teaser rate.
Okay, great advice. Now, people often hear about terms like assets and liabilities, just as you mentioned in the last question. Why do
Right.
these terms? What do these terms mean in simple language, and why are they important for building wealth?
An asset puts money in your pocket, like a productive investment or a business. A liability takes money out, like a car loan, credit card debt, or an overpriced purchase. Building wealth is less about being fancy and more about stacking assets while minimizing liabilities. Basically, buy things that help you earn or hold value, not be cautious with things that drain cash without return. That steady bias toward assets is what creates momentum over time.
Another distinction that I would like you to establish is between saving, investing, and speculating. Why should beginners understand them distinctly?
Checking. That's crucial. Saving is for short term safety, low risk. Investing is for long term growth using assets like diversified stock funds or a business. Risk exists, but so does compounding over time. Speculating is trying to profit quickly from short term price moves, much higher risk. Beginners should start with saving for emergencies, then learn the basics of investing for long term goals, and only speculate if at all, with money you can truly afford to lose. Clear distinctions help you avoid mixing long term wealth building with gambling instincts that can derail your financial independence.
In my purview, whenever people start investing, they try to become a pro trader right off the bat and take unnecessary risk. What do you suggest for a person that does not have a core job as a market trader? What do you suggest? Should he seek knowledge as a professional trader and go into this market of investing as a trader, or should he just invest in ETFs, index fund, and let the money compound over time?
Checking. That's a smart observation. Most beginners confuse investing with trading. Unless you're deeply committed to learning trading as a disciplined skill, I generally favor being a solid investor first. Use low cost diversified index funds or ETFs if available, Invest consistently, let compounding do the heavy lifting, and keep learning without rushing into risk. If trading genuinely interests you, study it, paper trade, manage risk carefully, and only then commit small capital. For most people, steady saving plus long term investing beats frequent trading. Patience pays.
ChatGPT, I had a great session with you. That was a lot of informative points. I will study them and definitely will engage with you again. Thank you.
Glad to hear it. You're welcome. Looking forward.
Viewers, I hope you are moving along with your financial independence journey, and I will be back with another topic. Until then, signing off. Allah Hafiz.